Hey, so I wanted to record this video yesterday. Actually, I tried to do a live. It didn't work because the baby was not cooperating. But I want to give you some tools and some tips and some knowledge about the stock market today, given that it is down another 500 or so points. And it's officially the worst week since the financial crisis, 2008, 2009. There are a lot of people confused and panicked or panicking rather about should they buy, should they sell, should they buy while it's low, should they just stay out, wait for it to go up, and all of this stuff, right? The first thing you need to understand is figure out what type of investor you are. Are you an investor where you're buying something, you're holding it for 3, 4, 5 years or longer, or you're a trader? Are you someone that's trying to buy a stock today and sell it tomorrow, buy a stock today and sell it within 3 or 4 weeks? Now, the latter two, day trading, swing trading, is a bit more difficult and a bit more risky. That doesn't mean that it doesn't make money. I have plenty of friends that do extremely well in both of those. However, the majority of us, based on how we feel about the market, based on how you're reacting right now because of the stock market, you check your 401k and you're just very upset about it, you're probably a long-term investor and you don't want to bother with the trading stuff. Those are two different types of investing, two different types of people. So that's number one. So this is for long-term investors, legacy investors, if you will, people who are buying things for generational wealth for the long term. This video is for you. If you're somebody that wants to do all the other stuff, that's fine. This ain't for you. So everything I'm going to bring to the table today, I have a few charts, a few graphs, and some stats that you want to be aware of. Number one is we've gone through this before. The stock market has gone through things like this before, and we've been fine, right? I've went and did some research 2 days ago. So mad cow disease, 2003, stock market dropped. The stock market is up 200% since then. We were fine, right? We're all alive. Everyone's fine. The stock market still survived. Swine flu, 2009, 2010, very bad. People are still here. We survived. The stock market is up 240% since then. What about Ebola, 2014, right? Outbreak. People were upset. Stock market dropped. We're up 60% since then. These types of outbreaks happen. They're never fun. They're never great, especially because people die from it. So that's never a good thing. However, for you as an investor, this is not the time for you to panic, pull everything out, or sell everything when things go low. That actually is the opposite of what you want to do. Another example, Nike, Apple, a lot of the airlines, a lot of the cruises are some of the stocks that are hit the most, right? Those are the ones that are dropping primarily off the map based on the news. The primary reason is a lot of those companies do a ton of business in China for obvious reasons. I think Nike sales, 25% of Nike sales is in the China region, as well as where they make their shoes and everything like that. Well, if you missing a fourth of your business, your stock price is going to decline. Your business is going to hurt at least for a little bit. Now, I want you to think of it this way, though. If you think that Nike is a great company, Nike is one of the stocks that my son owns. If you think that Nike is a great company, if you think that it's going to be something for the next 5 to 10 years that you're going to own and hold and allow it to grow, you would have bought it a month ago at $104 a share. That's what it was a month ago in January, about January 27th or so. It was like $104 a share. That's a good price for you. You're going to hold it for 10 years. You're going to just let that be the company that you think is going to be, or that you know is going to be based on your research over the next 5 to 10 years, right? Why wouldn't I buy it at 90? Why wouldn't I buy it at 86? That's a sell for me because it's still a quality company. They're just going through something right now. Based on Ebola, swine flu, all these other epidemics, that they do pass and things do improve. We have evidence that we know that these things improve over time. Overnight, I can't say that. Over the next month, and I don't know. Over the next 5 years, we're not going to be dealing with this anymore. We know based on past results and past evidence that we have a decent understanding this is probably not going to last forever. So if you still believe that if it's Nike, Apple, Delta Airlines, Carnival Cruises, whatever stock that you're looking at, if you know based on your research and based on whatever your methodology is, that it's going to be a great company 5, 10 years down the line, and you're going to hold it for the long term, then if you're already going to buy it at 100, it just got cheaper for you. Why not? Another example is Amazon. Amazon several months ago was at $2,000 a share. You, me, and everybody else, we all know Amazon is going to be here, right? We know that. We know that Amazon has done a lot of things. They're probably not going to go out of business anytime soon. And most people feel like it's the company to be, right? It's the stock to own. That doesn't change. It was $2,000 a share. You wanted to buy it then, right? Now it's 18. Now it's 19. Well, guess what? This is the time for you to get it while it's a bit cheaper and let it ride out for the next 10 or 15 years, because you already thought that. You already felt that the stock was going to be here and was going to be profitable at 5 years from now, 10 years from now. So that doesn't actually change. The company hasn't actually changed. The situation has, a temporary situation has changed around it. But if you still feel that Amazon's still going to be here 10 years from now, why not buy it at a cheaper price today? That logically makes no sense, right? It's more the fear and the you bought it and now it's dropping, and you're looking at it the wrong way. You are buying a business. When you buy a company, you are buying a business. If the business is on sale and you know that the company is going to be here 5, 10 years down the line, then it only makes sense to go ahead and just continue jumping into it. Now, that is the preaching segment, right? So I want to show you some evidence as opposed to just telling you what I think. I'm going to show you what people have studied. I'm going to show you what I know. And I want to show you two very, very simple charts to illustrate what I'm talking about and why I'm talking about it, right? So, all right, so I pulled both of these from JP Morgan. And here's the big thing, right? What I don't want you to do, what I'm afraid of you doing, and what most people, my clients included, tend to do is fall into a space where they think that they can pull out their investments because it's going down right now and somehow magically find a way to jump in at the right time. That is nearly impossible. You don't know when the market is going to go up. I don't know when the market is going to go up. No one knows. For example, right? Monday and Tuesday, I think the stock market was down 200%. On Wednesday, it was up. I'm sorry, 200%. Monday and Tuesday down 1,000 points each, right? And then it was up on Wednesday, I think like 400 and some odd points. So would you have pulled out? Would you have known to pull out before Monday and Tuesday, jump in on Wednesday, and then jump out Thursday and Friday? There's no way that anyone would have known that. So throw that out the window. We think we can like figure these things out. We can't, honestly. All right, so this is from JP Morgan, and it says that even missing a few good days can really undermine your portfolio's performance. So right here, if you missed 6 of the 10 best days, of the stock market calendar, right, that's going to really hurt your portfolio, because 6 of the 10 best days occurred within 2 weeks of the 10 worst days. Now, this is no guarantee. But what we've seen in the past is like we've had, yesterday, day before yesterday or so, one of the worst days ever. The best day, 6 out of 10 times, is going to happen within 2 weeks from now. And that's not all. That's just 6 out of 10. So if you miss 10 of the best days, right, because you pulled out and you missed 1 or 2 or 3 of the worst days, or the best days rather, your performance would have been at 2.1%. because you missed 10 of the best days. And that's not 10 months, that's not 10 years, just 10 days, you'd have gotten 2.1%. If you miss 20 of the best days, right here at the bottom, I actually switch colors. I think red is a little more compelling, stands out a bit more. There you go. You missed 20 days, you would have actually gotten a negative return. And then if you missed 30, you stayed out for a month. You said, I'm gonna wait until this virus thing is over and try and come back in. You'd have missed 30 of the best days at that point in time. That's it. You would have been negative at negative 2.35. If you stay fully invested, this is all the way from 99 to 2018. So there's a lot of bad things that happened through there, right? You would have made 5.62%. So you jumping out and trying to jump in and jump out and think you're protecting yourself, you're actually doing yourself a disservice by doing so. So you miss just 10 days, you're going to drop 3% off the top just by missing 10 days, 10 of the best days. You miss 20, you're even worse. You miss 30, that's really bad. And some people may say, 5.62%, is that great? Okay, yeah, but when you're going through controvirus and things like that, when people are losing 10 and 15%, making 5% is actually pretty decent. Now, also, I want to show you this. So we know that the economy, and when you zoom in, right, is going to go up and down. However, Even with the Great Recession right here, that's only a tiny blip. Once we are 5, 6, 7 years away from the controvirus, you're likely not even going to see that register anywhere on here. Like even the bubble, the .com bubble, it barely shows up in the long run. So people who are investing for the long run, for example, my son will be 2 in a few weeks. We holding this for 20 years, right? 20 years from now until 2022, the controversy is going to be something that no one's even going to notice. And the stock market has gone up through all of that stuff. The one time you had a minor dip, and it's significant because you can see it here, was 2008, 2009, and that was it. So all of these other little things, Brexit would be somewhere off in here. We were fine. Swine flu is somewhere off in here. Ebola somewhere off in this box. We were fine. So you got to realize that when you look at the long term, you're going to be all right. Those who aren't all right are the ones who are selling and panicking now. The ones who aren't okay are the ones trying to, buy and sell and game the market, trying to jump out now and then jump in at the right time. You don't know what the right time is. More than likely, you're probably going to miss the best day of the year or the best 10 days of the year because you thought you could up and time the market. So no, relax. Especially if you're talking about your 401k money, unless you're retiring in the next 2 or 3 years, you don't need to make any drastic moves. Relax, let the market grow as it almost always had. The chart I just showed you went all the way back to 1930. There are a lot of things that happened since 1930. And we've been fine each and every time. Swine flu, Ebola, mad cow disease, whatever, right? Over time, you're going to be okay. If you're a trader and you're buying and selling, you're trying to pick the right stock at the right time, and that's a different story. Can't help you there. You're on your own. But for us long-term investors, those who are buying quality companies and holding them for the long term, buying quality companies and investing for generational wealth, you're going to be fine. If I already thought that Nike was a great company, if I already thought that Amazon was a great company, Apple, Walmart, I don't know, Pfizer, CVS, the things that are falling off the map right now, if I thought those were quality companies 4 weeks ago, if I thought they were great companies 6 weeks ago, then they're still great companies now. It's just the controversy is just making people act crazy. So I'm all right. The prices come down on stocks I already wanted and I already believed in. I've already done my research on. Don't panic and get rid of them now because of a virus. What happens if I would have got rid of a great company back in 2014? I would have lost out on 60% in gains over that time because I was afraid of Ebola and say, oh, I'm just get out of this, even though I already knew that Amazon was still going to be good back in 2014. That wouldn't have made sense, right? If you have an iPhone and you love Apple and you bought Apple stock in 2014, Ebola hit and you like, I bought this because I knew that Apple was going to be great 5, 6 years from now. So why would you sell out? That doesn't make sense. You want to be consistent. You want to be consistent. The great investors are always consistent. So if it's $100 a month that you're investing, you invest $100 a month regardless of what happens because you've done the research and you know over time you're going to be fine. I can't promise what's going to happen tomorrow, next week, 2 weeks from now, or even 6 months from now. I can tell you based on history, when you start looking at 3, 5, 10 years, it's hard. It is really, really, really hard to actually lose money. So relax. This is temporary. I don't know when it's going to end, but I know that at the time, swine flu and mad cow disease and all that stuff, we all felt the same way then too, right? But it did pass. The stock market was fine. So again, mad cow disease, 200% gain since then. Swine flu, 240% gain since then. Ebola, 60% gain since then. Relax, calm down, and continue with whatever strategy you were doing. So if you're contributing 15% to your 401k, keep doing it. This is not the time for you to cash out and just wait and cash because you're going to wait and wait and wait and wait. And you're going to miss out on whatever the best days will be at whatever point this year. So relax. Don't get caught in the hype. Don't get caught in all the red signals and all that kind of stuff. Let things play out. You're going to be fine. If you're a long-term investor, you're going to be fine. You are buying a business, and business owners don't panic because of a week of a really bad week. No one sells like, it's a bad week, I just quit. Like, no. relax, continue with your strategy, continue investing. I bought more shares of Nike for my son this morning because I said it was a great company when I bought it back in November. It is still a good company. Why would I invest when it's just a little bit lower? All right, that's it for me. If you want to learn more, go to buildingbread.com/webinar. I have a free webinar to teach you how to invest without losing everything. I show you how to select some of the best mutual funds, some of the best stocks, and really test out if they would be a good idea for you. So if you're watching this video like, well, how do I know if Apple is great? How do I know if whatever company is good? Take the free class. It's free. And I'll show you how to figure those things out and decide what's right for you and what's not right for you. All right, that's it for me. Follow me on all social medias at Building Bread, Twitter, Instagram, Facebook, and check out the webinar. That's buildingbread.com/webinar. And I will see you guys later.